So, what exactly is gold revaluation? In simplest terms, it means increasing the price of gold relative to the US dollar. For decades, the US dollar was the currency, backed by the gold standard. This meant the dollar had a tangible value tied to gold. But in 1971, President Nixon took the US off the gold standard. The dollar became a fiat currency, its value determined by faith in the government. Some argue this led to the inflation we see today. By increasing the price of gold, the government could reset the dollar's value, combating inflation. Let's be real, guys. The US dollar is facing some serious challenges. We're talking about fundamental issues that could reshape the financial landscape as we know it. The national debt is skyrocketing, reaching unimaginable levels. The Federal Reserve is printing money at an unprecedented rate, adding fuel to the fire. Inflation is eating away at our purchasing power, making everyday essentials more expensive. From groceries to gas, the cost of living is climbing. Other countries are actively seeking alternatives to the dollar as the world's reserve currency. This isn't just speculation, it's happening right now. One of the biggest reasons why gold revaluation is back on the table is the sheer amount of debt the US government is carrying. We're talking trillions of dollars. This isn't just a number on a screen, it's a real issue that affects the economy in profound ways. This massive debt burden puts downward pressure on the dollar, making it less attractive to foreign investors. And then there's inflation. We all see it happening at the grocery store, at the gas pump. Prices are rising and our dollars just don't stretch as far as they used to. Revaluing gold could be a way to combat this inflation and stabilize the economy. By increasing the value of gold, the US could potentially shore up its financial standing. Countries like China and Russia are tired of relying on the dollar and are actively looking for alternatives. They've been diversifying their reserves, and gold is a big part of that strategy. If the US were to revalue gold, it could be a way to maintain the dollar's dominance in the global economy. It would be a strategic move to counteract the growing influence of other currencies and stabilize the financial system. Now let's talk about the Federal Reserve, aka the Fed, the big dog when it comes to US monetary policy. The Fed plays a huge role in influencing the price of gold, even though we don't directly peg our currency to it anymore. They do this primarily through interest rates and inflation. When the Fed lowers interest rates, it becomes cheaper to borrow money. This can stimulate the economy, but it also tends to devalue the dollar. Why? Because lower interest rates encourage people to hold less cash, since it's earning less, and look for other assets like gold to protect their wealth. On the flip side, when the Fed raises interest rates, it becomes more expensive to borrow money. This can help to curb inflation, but it also makes holding dollars more attractive, which can drive down the price of gold. Gold is traditionally seen as a hedge against inflation. When the cost of goods and services goes up, the purchasing power of your dollar goes down. But gold, being a physical asset with limited supply, tends to hold its value over time. The Fed knows all of this, of course. The global economy is a complex web of interdependencies. Events in one part of the world can have ripple effects worldwide. The Federal Reserve's decisions on interest rates can impact the value of gold. Emerging markets are reshaping the global order. China, Russia, and India are challenging US dominance. Currency value impacts trade balance and economic health. The US dollar has long been the world's reserve currency. Most global commodities are priced in dollars. Countries are exploring alternatives to reduce dollar dependence. Central banks are buying gold to diversify reserves. China is accumulating gold to strengthen its financial system. What would a gold revaluation look like, and what would it mean for you? This question intrigues economists, investors, and citizens alike. Revaluing gold has real-world implications. Imagine the US raising the official price of gold significantly. This unprecedented move would send shockwaves through financial markets. Overnight, the dollar's value drops relative to gold, recalibrating how we value money and assets. Your dollars wouldn't be worthless, but their purchasing power would be reduced, making everyday items more expensive. In the short term, we'd see chaos. Financial markets thrive on stability, and a sudden revaluation would disrupt that balance. The stock market might take a hit, but companies involved in gold mining could see a surge in their stock prices. Import prices would likely go up, leading to inflationary pressures. But this initial shock would be temporary. Markets would adjust, and the economy would find a new equilibrium. Long-term, a gold revaluation could introduce monetary discipline, leading to sustainable economic growth. Now let's talk about a wild card in all of this: central bank digital currencies, or CBDCs for short. These are digital versions of existing fiat currencies issued and backed by central banks. Think of it like a digital dollar, but instead of being controlled by commercial banks, it's directly controlled by the Federal Reserve. Some experts believe that CBDCs could pave the way for a new kind of gold standard, a digital gold standard, if you will. Imagine a world where your digital dollars are backed by physical gold, held in reserve by the Federal Reserve. This could potentially provide the stability and trust of the gold standard with the convenience and efficiency of digital currencies. China, for example, has already launched its own digital yuan, and they're rumored to be considering backing it with gold. If the United States were to follow suit and create a gold-backed digital dollar, it could be a game-changer for the global financial system. But of course, there are also risks to consider. CBDCs could give governments even more control over our money, potentially allowing them to track our transactions and even freeze our accounts. Okay, let's bring it all home. How could a potential gold revaluation coupled with the rise of CBDCs affect your money and your investments? If the dollar weakens against gold, your cash savings would buy you less. Diversify your portfolio and hedge against inflation. Gold has historically been a good hedge against inflation. You have options like physical gold, ETFs, and mining companies, but remember, I'm a firm believer in diversification. Consider other assets like real estate, commodities, and Bitcoin. Don't wait for a gold revaluation to start thinking about your financial future. So, you're probably thinking, Graham, this is a lot to take in. What can I actually do to prepare? Don't worry, I've got you covered. First and foremost, remember, don't panic. We're not talking about the apocalypse here, but it's always wise to be prepared for any eventuality, and that includes potential economic shifts. One of the smartest things you can do is diversify your assets. Don't put all your eggs in one basket. Make sure you have a mix of stocks, bonds, real estate, and yes, even some gold or other precious metals. If you're considering buying physical gold, do your research. Find a reputable dealer, understand the different types of gold coins and bars available, and factor in storage costs and security. Another crucial step is to manage your debt. High levels of debt can be crippling, especially during times of economic uncertainty. Focus on paying down high-interest debt first, like credit cards, and consider refinancing any loans with favorable terms. It's also wise to have an emergency fund. Aim for at least 6 months' worth of living expenses saved up in a readily accessible account. Gap 3S. Now let's dive into some shocking historical instances of gold revaluation and their far-reaching impacts. These examples will give us valuable insights into what could happen if the US decides to revalue gold. One dramatic instance occurred in 1933 during the Great Depression. President Franklin D. Roosevelt issued Executive Order 6102, requiring Americans to turn in their gold to the Federal Reserve. The government then revalued gold from $20.67 to $35 per ounce, devaluing the dollar. This move aimed to combat deflation and stimulate the economy, but led to public distrust and loss of wealth. In 1971, President Richard Nixon announced the suspension of the US dollar's convertibility into gold. This ended the Bretton Woods system, leading to economic uncertainty and high inflation. It marked the beginning of the fiat currency era, where money's value isn't backed by physical commodities. In 1997, the Asian financial crisis led to massive currency devaluations in Southeast Asia. Some nations, like Indonesia, turned to gold revaluation to restore confidence and attract foreign investment. These instances show that gold revaluation can have profound and unpredictable effects on the economy and society. They remind us of the importance of being prepared and staying informed about potential economic shifts. Gap 3S. Now let's explore some shocking potential future scenarios if the US were to revalue gold. Imagine the US revalues gold to $10,000 per ounce. This could send shockwaves through the global financial system. The US dollar would devalue, leading to skyrocketing inflation. Everyday goods would become more expensive. Countries might panic, selling off dollars and rushing to gold. This could destabilize international markets. Geopolitically, it could shift the balance of power. Nations with substantial gold reserves might gain influence. This shift could lead to increased tensions, stocks could experience extreme volatility, investors might flock to gold, causing a surge in prices. Traditional investments could suffer. For everyday Americans, the impact would be profound. Savings in US dollars could lose value, while gold investments could gain. Economic instability could lead to job losses and a potential recession. These scenarios highlight the unpredictable consequences of a significant gold revaluation. It's a reminder of the complex interplay between economic policies and global markets. Gap 3S, stay informed and be prepared for any economic shifts. Understanding the potential impacts can help us navigate these uncertain times. Gap 3S. While we've explored gold revaluation, there's another shocking aspect: gold price manipulation by major financial institutions. For years there's been speculation and evidence that some of the world's largest banks have manipulated gold prices. Gap 2S. Investigations have revealed practices like spoofing, where traders place large orders they never intend to execute to create false market demand. These manipulations can significantly impact gold prices, causing artificial fluctuations. Gap 2S. The implications are profound, affecting global financial markets and economic stability. For individual investors, this can mean the difference between profit and loss. Gap 2S. Moreover, it contributes to a lack of trust in the financial system. Understanding these dynamics can help us advocate for greater transparency and fairness. Gap 3S. Now let's move on to our concluding thoughts. Gap 3S. The true gold reserves held by countries often differ from reported figures, raising questions about transparency. Investigations reveal discrepancies like the US gold reserves at Fort Knox. This lack of transparency fuels speculation and affects global financial markets. Accurate data is crucial for a fair financial system. Gap 3S. Now let's move on to our concluding thoughts. Gap 3S. As we navigate the complexities of gold revaluation and national reserves, there's another layer to consider: how emerging digital currencies, specifically central bank digital currencies, CBDCs, might influence and be influenced by gold. Gap 2S. The advent of CBDCs is set to revolutionize the financial landscape, offering a digital form of fiat currency that is more efficient and secure. However, this digital shift brings with it some startling implications for gold. Gap 2S. Gap 2S. One shocking revelation is the potential for CBDCs to be backed by gold. This concept isn't as far-fetched as it might seem. Some financial experts speculate that in a bid to restore faith in fiat currency, central banks could peg their digital currencies to gold reserves. This would create a new gold standard in the digital age, fundamentally altering the value and demand for gold. Gap 2S. Gap 2S. On the flip side, the rise of CBDCs could also diminish the role of gold as a traditional safe haven asset. With digital currencies offering stability and transparency, the need for physical gold reserves might decrease, leading to a potential devaluation of gold. Gap 2S. Gap 2S. The relationship between gold and digital currencies is still evolving, and the future holds many uncertainties. Gap 3S. Gap 3S. Now, let's move on to our concluding thoughts. Gap 3S. Gold confiscation by governments is a historical reality with potential future implications for investors. Gap 2S. In 1933, President Roosevelt required Americans to surrender their gold. Gap 2S. Today, economic instability raises the threat again. Gap 2S. Diversification and vigilance are key for investors. Gap 2S. Stay informed and proactive to safeguard your investments. Gap 3S. Now, let's move on to our concluding thoughts. Gap 3S. As we navigate the complex dynamics of gold and its potential revaluation, one cannot ignore its performance during periods of hyperinflation. Gap 2S. Historically, gold has often been seen as a safe haven, a store of value that retains its worth even when fiat currencies plummet. Gap 2S. During the hyperinflationary period in Weimar Germany in the 1920s, the value of the German mark collapsed, but gold's value skyrocketed. Gap 2S. Similarly, during Zimbabwe's hyperinflation in the late 2000s, gold emerged as a critical asset, allowing people to preserve their wealth as the Zimbabwean dollar became virtually worthless. Gap 2S. Recent data also underscores gold's resilience. Gap 2S. In Venezuela, where hyperinflation has eroded the value of the bolivar, gold has served as a lifeline. Gap 2S. These examples highlight a consistent pattern. In times of extreme economic instability, gold has provided a crucial hedge against the devaluation of fiat currencies. Gap 2S. As global debt levels rise and central banks continue to print money, the specter of hyperinflation looms large. Gap 2S. If history is any guide, gold will once again play a pivotal role in preserving wealth. Gap 2S. Investors seeking to safeguard their assets would do well to consider gold as part of a diversified portfolio. Gap 2S. The data is compelling and the message is clear. In times of economic turmoil, gold shines brightest. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you never miss an update. Let me know in the comments what you think about the potential for a gold revaluation and how you're preparing. See you next time.